Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit highly appreciated assets, tax deferred, so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. And each episode, I'm joined by some of the best wealth, business, leadership, and real estate individuals in the world to share ideas, deal stories, and inspiration. So together, we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on the Expert CRE Secrets podcast, as well as the Capital Gains Tax Solutions YouTube channel. So hit the like button, subscribe button, notification bell. It really helps us out. Thanks for that. Our next guests are experts in cost segregation and the accelerated depreciation. It's a phenomenal strategy. They got decades of combined experience over here. And so we're going to learn a lot from Sean and Len Lichterman. How you guys doing?
Good.
Great.
Happy
Happy Friday. Long time callers.
Yeah, absolutely, man. So why don't you guys just give the audience a brief background on you guys' self?
Yeah. So my background starts in healthcare and tech sales. As I've been working with business owners, my dad's been in cost seg for decades. I would actually tee up to some of my business owners and clients when I noticed that they purchased new properties. Hey, have you run a cost seg analysis? The answer was no. Well, you may qualify for accelerated depreciation. Let me get my father involved. We'll run a quick estimate, see if this makes sense for you. Now I've taken more of a full-time role. The industry is just taking off like gangbusters. It's great to work in the quote-unquote family business with my dad, being boss and father at the same time. But it's very fulfilling to be able to work with clients, to be able to help them with their financial goals and ultimately just create generational wealth.
For those of you that can't tell, I'm the dad in this twosome. My background is accounting. I worked about a dozen years in corporate accounting for Fortune 100 type companies. From there, I migrated into real estate. I actually built single family homes for several years. I got involved in rental property quite heavily. And over the last 25 years or so, I'm involved in a 40 or 50 limited real estate, limited partnership investments. I've been affiliated with Cost Segregation Services. That's our company, CSSI, for about a dozen years now, and happy to merge our resources with Sean as well to kind of help bring me into the 21st century in terms of technology aspect.
Yeah, no, absolutely. So tell me a little bit about one or two of your guys' spiritual gifts, strengths, whatever superpowers you want to call them that have led you to be successful today.
Yeah, I would say one of the gifts was bestowed to me. I've been very fortunate to have great leaders in my life. My dad being one of them, my grandfather, actually my great grandfather, taught me the art of investing and saving early on. I mean, picture an 8-year-old with birthday cards, taking that money, putting half of it in a CD, and the other half asking my dad how to open up a Charles Schwab account. So having that knowledge early on has been a great gift, for myself, but then also to give that knowledge back to friends, clients, family, and even now, I'm very fulfilled in what we do today, in being able to advise property owners, business owners, in how to maximize their tax benefits and ultimately create that generational wealth. And I'm sure we'll get into that in more detail in the show here. But yeah, I'm definitely very grateful from our background and then what we're able to do day in and day out.
And most grateful and gratifying for myself is to be able to work alongside my son, putting out the word on cost segregation. Many years ago, I taught some business classes at the local college. And what I found most gratifying from that was students coming up to me afterwards saying, you've made very difficult subject matter easy to understand and comprehend. And I like to try to transfer that same expertise in defining and explaining cost segregation. It's the most gratifying to me is I have a client who's never heard of the term whatsoever, And after 5 or 10 minute chat with them, they've got a basic understanding of what it means and what sort of benefits it implies. So I like to keep things simple, kind of speak to the lowest common denominator of my audience, so that way they fully understand and grasp what it is that we do.
Yeah, that's a super important skill. So tell me a little bit about what cost segregation is. When's it useful? When's it not?
Yeah, let me jump in on that. In terms of what it is cost segregation is nothing more than a form of accelerated depreciation. As some of your audience may or may not know, when you purchase a commercial property, you have to depreciate it over a 39-year time frame, or 27 and a half years if people live in the property, if it's a multifamily residential type property. Going back about 20 years, there were a couple of court cases involving Walgreens and Health Corporation of America. And they kind of argued the point with the IRS, saying it's unfair to us to have to depreciate this entire building, this entire structure over 39 years, when we know there's various components within that building that just aren't going to last 39 years. Things like carpeting, things like molding on the walls. The parking lots typically only last 15 years. So that's what kind of led to the concept of cost segregation. And the IRS had approved the preferred method is an engineered approach, whereby we go into the asset and we break out the components that have lesser year lives, typically a 5-year lifespan, 7-year, and 15-year. And the concept of the cost segregation is it allows you to take those lesser life assets and bunch them together. And over these last handful of years, we can actually take that in the form of a write-off in something called a bonus depreciation. So it's a form of accelerated depreciation, fully accepted, fully acknowledged by the IRS. There's about 500 pages in the tax code describing it. But it allows the investor to take the depreciation on a front end as opposed to spreading it out over 39 years. The benefit to them is additional cash flow.
Right. So in addition to that, the benefit is just the time value of money, right? The dollar today is worth more than a dollar tomorrow. You know, the example we like to give is, if you won the lottery, do you want your lump sum today? Or do you want to wait 39 years to gather that? So, you know, in a roundabout way, that is cost segregation. Front loading your tax liability and to be able to reducing your tax liability in the first year. That creates greater cash flow. Go purchase more properties, put some renovation. Hell, take a trip around the world. It's your money. In a nutshell, cost segregation allows you to do that with your investment properties.
So you said that you're accelerating the depreciation, basically recategorizing the stuff inside of the building in order to give it a new depreciation life cycle.
Correct.
5, 7, and 15 years. So let's break down an example.
Okay.
Let's say you got a typical $5 million building.
Okay. Let's take a $3.9 million building, so the numbers work a little bit easier.
Okay,
so
3.9. You're the expert.
So they'll reach for their calculators. So you purchase a commercial building for $3.9 million. Now, what kind of building is that? Anything and everything. It could be a retail, a Dollar General. It could be an advanced auto store. It could be a hotel. It could be a bank. It could be a gas station. Anything and everything under the umbrella would qualify for this. So you bought it for $3.9 million. Traditionally, your CPA would then depreciate it over a lifespan of 39 years. So if you got $3.9 million divided by 39 years, you're taking $100,000 a year write-off, which is all. That's good. It's better than nothing. However, by applying cost segregation, we're going to look at that same building and probably identify 30%, upwards of 30%, or maybe even more, depending on the asset, of the purchase price will qualify for the 5, 7, and 15-year asset categories. So if you're taking 30% of that same $3.9 million, you're looking at maybe roughly about $1.2 million of first-year write-off versus $1 million. Versus $100,000 of first-year write-off. That's a 12-to-1 difference. So what would you rather have, a $100,000 write-off in the current year or $1.2 million? And as you can see, it would take 12 years of straight line depreciation at $100,000 a year to equal the same benefit that you're achieving in the very first year with cost segregation. So you take that $1.2 million of additional depreciation, depending on what tax bracket you're in. If you're, let's say, at roughly a 30% tax bracket, that equates to a $400,000 after tax savings. So if you owed the IRS that particular year, let's say $100,000, we've completely wiped out your current year tax obligation, and you can roll forward any of the unused benefit in future years.
Does the depreciation that's coming from 5, 7, and 15, you said you get 1.2 up front on this example. Where is that 1.2 coming from? So is it not that like
No.
you would get 1.2 for the 5 years, and then you would get 700 for the 7 years, and then you would get 400 for the 15 years, and the rest for.
Well, the whole amount would be the 1.2. So if you've identified roughly 30% of the purchase price falls into the 5, 7, and 15-year categories. The 5-year categories would be things like flooring, moldings, and so forth. The 7-year would be appliances, washing machines, things of that nature. The 15-year would be the parking lot, signage, landscaping. All of that would fall into that category. So the three of those combined would equal that 30%, or that 1.2 million out of the 3.9 million.
And it may vary from property to property as well. We're kind of giving just an industry average. We'll talk a little more in specifics of car washes, gas stations, which do a lot more higher reclass. But on average, you can pretty much pinpoint 20% low end, upwards 40, 50, 60% if it's a car wash, gas station. But
sometimes
right in the middle, sometimes 100, but right in the middle, it's safe to say for a multifamily, a QSR, a dental office, your typical brick and mortar that you're driving by on the street, it's going to be right around that 30, 35% reclass.
I guess what I'm trying to understand is when you do the cost seg, right, and you take the 15, 7, and 5 year, depreciating assets within the building, right? Why do you get to take all of those in year one and not break it out into 5, 7, and 15?
All right, that's what we were describing is what they call the bonus depreciation that was put in place in the Tax Cut and Jobs Act back in 2017, whereby they allow you to take the 5, 7, and 15 year and bunch them all together and take a 1 year bonus, if you will, depreciation. Up until this year, it's now beginning to phase out at 20% per year. So anything put in place in 2023, instead of getting the 100%, you get 80%. Next year, it'll be 60%, and so on and so forth. So that's where we came up with that 30%, or the 1.2 million out of the total purchase price of 3.9 million.
Is that something you have to take? Like, for example, let's say that your year is, from a taxable perspective, right? You're in the $500,000 income. And then, if you take the 1.2, you'll have that 400 that could wipe out that entire thing. But then the following year, right, you're not going to have that. Well, you're going back to the 100,000, right?
Yeah, and the remaining 70% that didn't qualify for bonus will continue to depreciate over the remaining 39 years life. So you'll still have some additional straight line.
So I guess, do you guys sit down and strategize like, okay, we know you're going to probably bring in X number of dollars this year, and next year you're looking like you're going to be on track for a similar kind of situation. So instead of taking the full thing, maybe we do half. We do 600 now and 600 next year so that we're offsetting. Or do you just carry forward on your tax returns the depreciation?
There's a couple of options, right? One, you can carry it forward. I think the good thing to know is that property owners, they have options, right? So one would be carrying it forward. The other one, if they are a real estate professional, they can actually apply that to their personal income to offset that if they have a high operating income on their personal side. But we do work very closely, and really the name of what we try to do is not just get into one cost seg and that's it. The whole meat and potatoes, or the key to success in real estate investing is purchase, defer, exchange, repeat indefinitely. You want to create this generational wealth, and that is the process of doing so. Purchase the property, defer your liability by running a cost seg study. When time comes to sell the asset, you can exit by either 1031, Deferred Sales Trust, but rolling that into now a new property. So you're creating that portfolio of properties indefinitely. So when you do pass, you're passing down this entire portfolio of investment properties down to your heirs at the step-up basis. So, it's not really meant for those who want to just get into one property. It can help you there in terms of just, finding capital for renovations, or, to just defer your current year tax liability. But it really works the best for those investment owners who want to keep purchasing properties down the line.
That makes a lot of sense. When you're talking about the generational side of things and using it as a tool to leverage up so that you can go out and acquire, more assets.
Right.
So thanks for the context there. Okay. What are some of the pros and what are some of the cons that people need to understand when they're looking into a cost seg?
The pros being, right, so it's an accelerated form of depreciation. So you're able to wipe out your current year liability or reduce it quite significantly. That's just creating better cash flow, like we said before, right? So you can go purchase more property. You can put renovations in your current property. Take a trip. It's your money. It's the time value of money there. When it comes to the side effects or the negatives to cost seg, there really aren't many. It's just if it's a fit for you. That may be if you're operating at a loss, right? You may not need to do a cost seg study, or if you're doing just a quick flip.
Yeah, in most cases, as far as we're concerned, there's really only two reasons why you would perhaps not venture into a cost seg on your property. First one being, as Sean mentioned, if you just don't have any tax liability to defer, if your property is not throwing off any income. Although a caveat to that is if you feel that your property will begin generating income in years moving forward, it may behoove you to do the cost seg analysis this year and roll the unused benefit into future years because of the declining bonus depreciation. This year, if you put the asset in place in 2023, you'll get 80% bonus. If you wait a year, you lose another 20 points. You'll only get 60%. So it may benefit you to do the analysis this year. If you don't have any tax obligation offset, that's fine. Roll it forward into future years. So that'd be one possible reason why you wouldn't do a cost seg. The other one, as Sean alluded to, is if you're going to buy and flip the asset in a year or so, because they've got this thing called recapture, where you've got to pay a tax on the depreciation that you took. So you've got to give a fair share of the benefit back in the current year. Although, having said that, we've had a number of clients that will still do it because they got a year's worth of other people's money. They were able to use the money that for a year that they didn't have to pay in their taxes, knowing that they had to pay it back in a future year, but they got the benefit of being able to utilize the money for a year or so. But those would really be the only drawbacks that we come across.
This the depreciation recapture how does that work?
Well, the depreciation that you got, let's say you got $1 million worth of tax relief as a result of the cost seg, and then you flip the property next year, you've got to pay a 25% tax on that on the benefit that you had received in the current year. So there's a little bit of a give back there. You got to pay the piper sooner or later.
So would it be in our $3.9 million situation, right? Your 1.2 that you did the cost seg on, you got the bonus depreciation. If you were to go ahead and flip it in, 2 years, are you saying you would have to give around $300,000 back?
That's correct.
Okay. Still a good deal. I'd rather take $1 million now and give 300 back, right?
Yeah.
Still the time value of money. That's what it boils down to. In cost seg, you're not getting any more, not any less. It's really just accelerating the depreciation to have it today. It's reversing the standard 39-year depreciation schedule.
Interesting. Okay. In the cost seg study, you mentioned that there's different assets that are, I don't know, performing better, I guess, or whatever, right? Car washes, gas stations,
different industries, right?
Different industries. What is it that someone should be looking at if they have a building, right? The first thing they should do is probably just call you guys. But and they can, you guys, the best way to get a hold of you guys would be your LinkedIn, Sean.
Yep, they can follow LinkedIn, Sean Lichterman. I do also have an Everything Cost Segregation. It's a LinkedIn page where I post weekly tidbits on cost seg. This would be one of them, just a niche tidbit for the week, or email, which I believe you have displayed as well.
Yeah. So email is sean.lichterman@costsegregationservices.com. And your LinkedIn is at everything cost segregation. So that would be the first thing. But if you're not going to do that, right, and you're looking around, what industries are you guys seeing that are typically really, really good for a cost seg study?
Well, you hit the nail on the head. First off, if you've purchased any kind of building, you need to look into it to see if you benefit from cost seg. The more complex the building is, the more components within the building, the more offices within the building is going to increase its potential bonus depreciation. In other words, a medical dental building is going to fare a little bit better from a cost seg standpoint than a warehouse. Because what is a warehouse? It's nothing more than four walls and an empty space in between. So there's not a lot of complexity to that. There's certain industries, though, that really hit a home run. The IRS grants favorite recap to gas retail. So if you're a gas station, let's say a 7-Eleven that also has a retail and gas combined, a couple of qualifying points you have to make. If 50% or more of your revenues come from gas sales, then you qualify for a 100% write-off. That was if it was put in place prior to 2023. If you put it in place in 2023, you'd get 80%. So if you bought a $5 million gas retail and you met the revenue test, you'd be able to take 80% of the $5 million or $4 million today, this year, and apply it against your 2023 taxes. Car washes, primarily what we call the tunnel type car wash. That's where it's just a single building. They don't sell food there. They don't have a coffee shop or whatever. But if it's just a basic tunnel type car wash, those also qualify for the 100%, now 80% write-off. Another good industry over the last several years is short-term rental market.
Airbnbs, VRBOs, right.
Right. Yeah, those tend to do very well because typically those are highly amenitized, especially the higher end ones. You got the granite countertops, hardwood floors, finely finished bathrooms and kitchens and so forth. And all of that qualifies for typically 5-year asset life. So it would all qualify for the bonus. Oh. So we're finding sometimes if you purchase $1 million Airbnb, upwards of 40% of it, perhaps 400,000 of it, would qualify for a first-year bonus.
That's interesting.
And then on the flip side, some of the less complicated buildings have done a ton of like Dollar General stores. Again, what is a Dollar General store? It's nothing more than a small warehouse with a couple of offices and a bathroom, perhaps. But even those typically qualify for about 25% of purchase price will be reclassified. So going back to your original statement, anything and everything in between. The first thing to do is just check to see how much. Check with us. We'll turn over an estimate within 24 hours and let you know exactly how much we estimate that it'll qualify for accelerated depreciation.
What about the property owner who's owned the property for 20 plus years?
Yeah, traditionally, from a return on investment standpoint, in terms of what they're gonna pay us for our fee versus a return on that, it's really going to be diminished. So we normally will draw the line at anything purchased within the last 5 to 7 years. That way, you're going to get the biggest bang for the buck from our analysis.
It might make sense for that 20-year property owner if they put in $500,000 of renovations. Then it may make sense to do the cost seg study. So it's not just also for newly purchased property. That tends to be more of what we see, but it also qualifies for any renovations. And typically, anything above $250,000 is going to be good for cost seg in a renovation standpoint.
That brings up this question: are there certain minimums and stuff that you guys have that you're like, okay, at this point it doesn't make any sense?
Yeah, so typically the bottom, so CSSI, we've done 30,000 studies. We're actually the largest engineering cost seg firm in the U.S. And we've done cost seg studies on properties from 150,000 all the way up to 750 million. Where we typically like to go, where we see like the best return on investment is going to be that property right around 300,000. That's where the cost seg study fee, the accelerated depreciation makes sense. One of the, we can also touch on this a little bit later, but one of the stigmas is, well, I have to have, a tens of $1 million property, a huge hotel or something. It's not true. A lot of our clients fall within that $800,000 up to 5-10 million. we do like working with the 25 million plus properties, but as we're saying, one of the hottest markets is that short-term rental. So that maybe $1.2 million home that you're purchasing up, those are perfect. And that's where you start seeing that snowball effect of get your accelerated depreciation, and then go find another property. And that's what's enabling these, kind of ma and pa investors to really create that generational wealth under them.
But as Sean alluded to, just a $300,000 single family home that you've put out for rental, that would qualify, and you'd get a decent return on your investment as well.
Yeah, that's interesting. Okay, what about if a property is sold? So hypothetically, right, this $3.9 million property that we were talking about, the previous owner did a cost seg study on it, and then the new owner came in and buy it, and now he's doing a cost segregation study. Does the previous depreciation affect the new depreciation? Does it roll over
to the new owner, to a separate owner?
Does it roll? Yeah, does it roll over? So the IRS is not looking at it as like, okay, this building has already been depreciated.
Right. It starts all over again. So you own the building, you sell it to me now for $4 million. I can now perform a cost seg on a basis of $4 million. You're going to have some tax consequences by selling it for, over and beyond what you paid for it, minus your depreciation, and that's where the 1031 exchange comes in. But in answer to your question, it starts all over. So just because you've depreciated a building previously, once it exchange hands, it starts all over again.
Do you find that interesting that it does that? Because isn't the whole point like the asset is going down in value, or its useful life is becoming shorter?
Yeah, right.
And so like it's just what resets the useful life is someone coming in and buying it again.
It's interesting, yes, but we also enjoy the benefit of it.
No, it makes sense. I mean, hey, shoot, like
usually what we end up seeing is that most owners will come in, they'll throw renovations into it. So very seldom do we actually see a property just stay stagnant, especially if it's been owned for 10, 15 years, because these aren't quick flip buyers. They may hang on to the property for 5, 10, 15 years. So at that point, the new owner will want to put renovations in. Flooring is going to go, moldings, parking lot, things of that sort.
Okay, so I want to ask you guys about the depreciation kind of carryover that you do within a 1031 exchange. So if you do a cost seg, right, and you sell the building and you do a 1031, you have to carry the depreciation with you as you go and upgrade into new properties. Are you guys finding that to be any sort of kind of like a tension point within your guys' industry?
Not really. And I'd say the reason being is that we partner with a number of other industry professionals, CRE, realtors, brokers, lenders. And that's really where our partnerships come into tale, where when our client's ready to sell, now our partner that's in commercial real estate or commercial realtor can find them a property of equal or more value. So we become a valued asset to a lot of our partners, because every time we bring a client to them, they're purchasing more and more often.
But if you do sell an asset and you do a 1031 exchange, you roll in another property. Obviously, your basis has now been reduced by the amount of the gain that you've deferred, but you're also eligible to do another cost seg on the new property. So, in Sean's point, continue to defer and push the
buck down as far as I can. Yeah, just a purchase, defer, exchange, repeat.
So I guess what I'm getting at is like when you do, going back to our $3.9 million building, right? Mm-hmm. You sold it, you did cost seg, you deferred, or captured 1.2 million. A couple years later, right? You sold the property. So you've depreciated, let's say 1.5 million.
Okay.
Of essentially the $4 million asset. When you go and you do an exchange, you've got 1.5 that's already kind of like taken off of the depreciation. So if you bought the new building for 5 million, right, you really only have 3.5 left to depreciate. How does that affect the cost segregation study on the future building because you did it in the past?
Well, there's still, I mean, so you got a brand new cost seg at 3.5 million. That becomes your new basis. Assuming you it qualifies for another 30% bonus, let's say, so you can take off another, roughly $1 million depreciation on that building as well.
So the value of the actual like equipment and carpet and whatnot actually is devalued then at that point at some level, right?
Yes, right, in a sense.
That's interesting.
Mm-hmm.
Okay. One of the things, and I'm kind of leading into this plug here, but one of the things that is nice about the Deferred Sales Trust is that when you do go back into real estate, you get a brand new depreciation schedule. It doesn't follow with you.
Right.
When you guys do your cost seg studies, I'm assuming you're charging on a percentage of the amount that you have found.
There's a fixed portion, to cover our fixed costs, and then there's a variable portion as well as the complexity of the building factors into it also. But yeah, it's somewhat variable based on a dollar.
So in a sense, like it's sometimes it would behoove everybody if they didn't have to carry that depreciation schedule over. Does that sound like pretty accurate?
If they didn't have to carry forward?
Yeah, I mean, I would rather have the 5 million total to depreciate on top of the 1.5 million that I depreciated, with the building that we sold, right? Like, and get a whole brand new depreciation schedule instead of being down, $1.50. Right. I mean, that seems to make sense to everybody. So I think that's kind of what I'm getting at here is like within the 1031, are you seeing that as a challenge for other people that are coming in? Like, okay, I've depreciated way too much of, I've done 3 1031s, and all 3 1031s I've done cost seg studies. And now there's just not enough depreciation left in this big building because I've depreciated all of these and it's had to carry forward every single time.
Yeah. I've personally not seen that where they've run out of carry forward depreciation. I've not come across it as being a major concern. It kind of enables you to keep rolling into a larger and larger asset, more expensive asset. And again, it's this wealth building and generational wealth building that you can pass on.
And on the exit strategy side, I mean, we're not really heavily involved in the 1031 or even deferred sales trust. That's where we actually pass it on to our partners and into our internal network. We really want to just be main focus on the cost seg side, because it does vary between property owners' goals, what property type they want to get into. But the main focus is that they do have options, right? 1031 may work for this individual. Deferred sales trust may work for this other individual. In our personal experience, I would say on average, it hasn't really been a hiccup, mainly because, we kind of keep our hands clean. We don't really work in that environment, but, it works because then they're calling us up again on the new property, run me another cost seg, whether they're applying that to their current property or they're a real estate professional applying that to their personal income. Once again, they have options. The main benefit is that they just want that accelerated depreciation to give them that function.
Yeah, it's really interesting that the tax flow side of things is becoming more and more and more important, like in all facets of the investment landscape right now. Because I mean, you got your cost seg studies that can help you. You got your capital gains deferral strategies that can help you, right? You got things that can help offset your income if you're professional in real estate, right? Like that was cool. I didn't know that you could do that. Those are I think that people are starting to like really catch on to the fact that like, okay, if I don't figure out a way to like defer these taxes or kind of offset them at some level, I'm going to get hammered. And that's just, it's people like you guys, it's people like us who, are kind of preaching this, this message, if you will. It's like, hey guys, look, like this is something you got to pay attention to. When you buy a building, you need to be thinking about how can you mitigate taxes. When you sell a building, you need to think about the tax ramifications. When when you're generating the income, right, you need to think about the tax ramifications, because if you don't, you're gonna get screwed.
Absolutely right.
And it helps even working with certain wealth advisors, because then it's actually helping them single out what property is best. a multifamily may not be the best asset to purchase. It may be a car wash. It may be the gas station, because now you're taking that 100% write-off right away, which is reducing your taxable liability. So now we kind of become, like you said, kind of an advisor or a strategist in terms of, we're not just going out point blank picking and shooting. That was actually a conversation we just had with one of our partners just earlier this week. Like, I'm going to get into a multifamily. Well, actually, if you got all this personal income on the side, you may want to actually look into gas stations or a car wash, because that's going to give you a heavy hit to reduce even lower.
Yeah, no, that's super interesting. So, okay, if you guys want to learn more about the Deferred Sales Trust and how to not have to carry forward that depreciation schedule, so that when you call Sean and Len, you have way more to depreciate, come to our mastermind every Friday at 10 a.m. Pacific, 1 p.m. Eastern. And you guys can go to our website, capitalgainstaxsolutions.com, and sign up for that. It's a phenomenal way to create, preserve, and grow your wealth, passing it down through the generations like we've been talking about, as well as, use with conjunction with strategies like Sean and Len's, cost segregation studies and whatnot, so that you can create, preserve, and grow that wealth. We're kind of running up on the time here. So one more time, where can people find you guys?
LinkedIn, my first and last name, Sean Lichterman. I also have everything Cost Segregation. I post weekly updates or just my email, sean.lichterman@costsegregationservices.com.
Awesome. And you guys can go to capitalgainstaxsolutions.com to sign up for the mastermind, or if you want more information, you can schedule a call with us there. Are you guys ready for the lightning round?
Lightning round. Let's do it.
All right, cool. What is your guys' favorite leadership quote?
It's by what's his name? Blanking. I think now you put me on the lightning round. But the favorite leadership quote is, "Hard work is often missed by most because it's looks like a shovel and covered in overalls."
Interesting. Okay. What's your favorite book?
One actually we just recently read, Phil Knight, Shoe Dog, right? So the co-founder of Nike has a great anecdotal on how he started the company, how he ran it, some of his pitfalls. If you haven't read Shoe Dog by Phil Knight, I would highly recommend it. It's a phenomenal book, an easy breeze.
Interesting. Okay, cool. What's the best piece of advice you've ever gotten?
Fat, dumb, and stupid is no way to go through life.
Fair enough.
That actually might be my best quote as well.
Fat, dumb, and stupid is no way to go through life. I love it. All right, cool. Okay, guys. Well, thanks so much for coming on. If you guys want to reach out to Sean, everything Cost Segregation on LinkedIn, best way to get in touch with them, or email Sean.Lichterman, LICHTERMAN @costsegregationservices.com. Go ahead and email or find them on LinkedIn. That's probably the best way, it sounds like.
Yeah,
correct. Yeah.
And of course, Capital Gains Tax Solutions. Come learn more about the Deferred Sales Trust, why we love it, why we love cost segregation studies, why we love them together. They're amazing. They'll save you so much money. It's unbelievable. Okay, cool. Any parting words, you two?
Well, first off, thank you very much for having us as guests
Thank you,
today.
Chris.
Yeah, it really has been great. Hopefully, your viewers and listeners have found some inspiration through cost seg and some tax benefits for their real estate investing. But yeah, I'm sure people are ready to get to happy hour, so appreciate it. We'll leave our plugs on the YouTube and Spotify channels.
Sounds good.
Thank
Awesome.
you. Thanks for your time.
You're welcome. And thank you guys for your time. Really appreciate it. And thank you guys for watching another episode of the Capital Gains Tax Solutions podcast. As always, tax flow is really important, guys. And using tax deferred strategies such as cost segregation, deferred sales trust, 1031 exchange, they're super vital. And not having a clear plan is the enemy. So get with people like us. Get with Sean and, Lynn. If you got buildings, get with us. Learn about the Deferred Sales Trust. Learn about 1031s. Learn about why you should use one over the other. Create, preserve, and grow your wealth. So please rate, review, subscribe. Hit the like button, subscribe button. Comment. What else? What else should they do on the interwebs over there? Tag.
Tag, right?
I don't know. Whatever.
Smash a like.
Do whatever you guys want. Just keep coming back. We'll see you guys on the next one.
Thanks.
Have a good one.